I train directly under industry leaders with IUL to currently serve 24 clients, and today I'm going to go over the 3 types of policy loans that you can use to access your cash value. First, what is a policy loan? A policy loan allows you to borrow against the cash value in your Index Universal Life policy. Since the insurance company is obliged to loan you that money, since it's your cash value, the loan isn't subject to a credit check and you don't need to follow a repayment schedule. Instead, you can decide to repay it if you would like, or whenever you pass away, the death benefit will pay off the remaining loan balance. So the first type of policy loan is a standard loan, sometimes referred to as a zero wash or a fixed loan. This is going to be the simplest option. You are loaning at a fixed rate and you are getting credited a fixed rate from the insurance company. These are generally going to be more advantageous in the later years of the policy. It depends from company to company, but in this example here, in the first 2 years, we have the loan rate at 2.25%, but the insurance company is only going to credit you 2%. So this would not be considered a zero wash because they are not equal and opposite. In this case, you are actually paying 0.25% interest on your loan, which is not a bad deal to get your money out tax-free. But if you wait until year 3, the loan rate is still 2.25%, but the crediting rate is also 2.25%, equal and opposite. This is where we would get the term zero wash. Now, what is important to note is these are the current rates that the insurance company is offering. They also have a column which is their guaranteed rate. So technically on these fixed loans, they could switch it up to as high as 3.25%, and they only guarantee that they're going to credit you in both cases just 1%. So in the worst case, you could be paying 2.25% on your loans to access your money tax-free, which still is not a bad deal, but it is important to note that the insurance company does have the power to do this, which again is why it is very important to go with an insurance company that has a very good track record, has never done this, and also has a great history of treating their older policyholders well. The second type is an index loan. These are going to be where you're loaning money out at a fixed rate, but that same money is going to say indexed or linked to the indices that you choose, giving you the opportunity to earn some money on the money that you've loaned out. In this example with this company, they actually do not offer the index loans in the first 2 years, and after that, the current rate is 5%. This will vary, it will track very closely with the Moody's yield, which will change with volatility in interest rates, etc. But if the Moody's yield is moving higher and the loan rates are going up, it's also very likely that the cap rates are rising. These things aren't directly correlated, but tend to be positively correlated. And then also, if you do take an index loan, say that current rate was 5%, you do have that 5% rate locked in for the year. So if you got it at 5 and right after the Moody's goes up and it rises to 6, you're still going to pay 5 for that 1 year period. At the end of the next year, then if you kept the index loan, you would get whatever the current rate is at that time. In this case, the guaranteed rate is 8%. Some companies have guarantees much lower, even as low as 5. However, this does kind of worry me just in that if the Moody's was really performing at a 6 and 7% rate of return, are the insurance companies really just going to take this loss by guaranteeing you a 5% cap? I don't really think so. I think they're probably going to pull from other areas or raise the cost of insurance, which, just as I mentioned with the standard loans, is very important to go with a company that has a track record of treating their older policyholders very well. Now, the reason that someone might go with these is because they can be very advantageous. I'm going to show you a good example and a bad example of what can happen with these. If you had a cash value of $1 million and wanted to take an index loan of $100,000, let's use the current rate of 5%. So that means after 1 year, the loan balance would be $105,000. That'll be the same for both. We're going to split up our cash value into 2 categories here. So our cash value, our total accumulated value that's still linked to the index, is $1 million. Our surrender value, that's what we have access to, is $900,000. That's just because we already loaned out $100,000. Of course, that means we're going to have $100,000 less to loan out if we wanted to. Then our loan balance is $100,000. Now, if we were linked to the S&P 500 on a 1-year point-to-point and the market gains 10% that year, this would be a very advantageous thing to us. Reason being, your cash value is going to be 1.1 million, of course, because you gained 10%. And then your surrender value, our surrender value plus our loan balance is always going to equal that accumulation value, is going to be 995,000. So not only do we gain the 10% on the 900,000, also gained the 10% on the accumulated value, making our total gain on the loan, even though we took that money out, we actually made $5,000 this year on the $100,000 that we already took out. Maybe we already spent it, we still made money on it. That's what's called a positive arbitrage. Now, on the flip side, if we have the same scenario here, but the market didn't go up 10%, the market went down, so we had a 0% return because we had that 0% floor. In this case, our cash value is still going to be the $1 million. That's not going to change, but our surrender value is actually going to drop by that little number there that we had to pay interest on the loan. So it's going to be $895,000. We actually lost $5,000 on this loan, which essentially means we did have to pay the 5% interest on the loan and we didn't get credited anything. Still, to access this money tax-free, this really isn't a bad scenario. The main time to look out for this is if someone was taking retirement tax-free income, they turned on these index loans. Say the market had 3 bad years in a row, 3 down years in a row, you had to pay that interest, you weren't actually making money on that. If you're not holding your annual reviews, this could be something you need to tweak, slightly lower the income to make sure everything's okay. Generally not going to be a problem. You just need to host annual reviews with your agent. They need to make sure that they are taking care of you. Third, the last way to access your money technically is not a loan, but is through withdrawals. These are taxed first in, first out. Since the cash value inside of a life insurance policy is technically growing tax deferred, even though you're able to access that money tax-free through policy loans, if you were to withdraw, everything up to what you have contributed is actually able to be taken out completely tax-free. So if you did want to withdraw, you didn't want to deal with the loans, you can take out, if you put in $1 million and it's grown to 2, you can take out that first $1 million tax-free, but anything above that $1 million that you've taken out that you contributed, that is going to be fully taxable, just like a 401k or an IRA. They are tax deferred, which is why when people are talking about accessing your money through an index universal life tax-free, they're generally talking about policy loans, not withdrawals. So those are the 3 types. Which one is going to be best for each person is always going to be situational. Me personally, I would always use the indexed loans, especially if we're loaning at a rate like 5%. We know very well that IULs are tracking much higher than 5%. And if that's the case, I would like the chance to earn that positive arbitrage. If you're looking for guidance on how to use your policy loans, you would like to take a look at a personal policy for yourself, book a 20-minute quick consult with myself down below. I would be more than happy to help.